Kick off with the stock of the day, a stock that I choose that's in the news. Thought we'd take a look at GUD today, nearly tripling its final dividend on year as revenue and profits soared, but in the same breath saying the current environment is too dynamic to provide reliable full year guidance. Will this be a bit of an insight into earnings season coming up? Will companies squib on any earnings guidance into the future? Use the old, or it's too hard to predict with COVID. On the segment, management saying that the water business should improve this year while automotive growth will normalise over time. GUD declaring a final dividend of 32 cents a share, up from the 12 cents a share dividend it paid last year. Andrew, what do you reckon of GUD's update and the stock at the moment?
Yeah, look, it's a great result when you look at it compared to last year. Although you have to, when you take a broader lens to this, you see that it's actually a pretty lumpy business. So it tends to move around quite a lot. So on a per share basis, they're back to where they were in 2019 and below where they were in 2018. In fact, they're below where they were back in 2012. So it's sort of been this, and you can see the share price chart there sort of shows you what you tend to see with these guys. Sort of zoom out a little bit, even over a 5-year period, it tends to it has at least trended pretty sideways. There you go. So one of the interesting things, I haven't had time to fully digest the results, but they talked about cost inflation pressures, supply chain issues pressure, and Koshi, you mentioned before US reporting season. Those were things that were mentioned or have been mentioned quite a bit as well. So something to keep an eye on there. So look, it's far from a terrible company, but it's not one that you'd probably go for if you're after a nice consistency and visibility and earnings. And management have basically said it's too hard to predict, too dynamic at the moment as well. So all that being said, I think they're on a PE of about 17 or so, which in the current market is not too terrible. I noticed that the brokers and analysts that cover it have forecasts that are calling for sort of mid to upper single digit growth going forward. We know those guys don't have the best track record. None of us do when it comes to forecasting those kinds of things, but it is encouraging. So it's a nice result in context of last year, but zooming out a little bit, it doesn't really set the world on fire.
Right, Michael.
Yeah, look, the numbers came in just very, very slightly above where they had guided the market a couple of months ago. Although the tone of management's comments had moderated somewhat from 3 months ago. 3 months ago, they seemed pretty optimistic over the next sort of 24 to 36 months about where all parts of the businesses were heading. And they seem to have pared back that language a little bit. And that's probably why you've seen the share price, or at least it was earlier in the day, down a little bit. So look, for mine, it's very, very similar reasons that Andrew's mentioned. Very lumpy balance sheet. It's hard to get any sort of confidence in the long-term outlook of this company when it hasn't really delivered on that in the past. In saying that, the balance sheet is pretty tidy. They do have some ammo up their sleeve if they want to conduct some acquisitions that could propel the next level of growth. But from a long-term standpoint, I would expect, low to mid single-digit top-line revenue growth over the medium to longer term. And for that reason, I just think there are better opportunities elsewhere. So it's not really a hold for me either, because I would sell it and look for other things to buy.
Yeah, following the announcement, it is down in a market that's slightly up this morning. So I think the market's agreeing with you there.